Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. We're going to do a July recap, talking a little bit about CPI, inflation, the Bank of Canada, what's going to happen in September, what are some of the things that you should be paying close attention to, especially if you're thinking about buying or getting into the mortgage marketplace. Stay tuned, you don't want to miss it. On this episode, we're going to take an opportunity as we end off the month of July, take a quick recap about what has happened over the month of July as we embark in August and pushing us ever so close to that next Bank of Canada rate announcement. On this episode, I want to take an opportunity and explore some of the current state or current conversations happening in the Canadian housing market, as well as the implications on Canadians and what it could mean for the Bank of Canada. So taking a very high-level approach, just to do a quick recap for those of you that may be tuning in for the first time, maybe you're about to get into the market and you're looking for some information. Obviously, you may be aware that inflation and those CPI numbers, the headline inflation in Canada, came in lower than expected at 2.8% for the month of June, returning to its lowest level since we've seen since March of 2021. And this is within the Bank of Canada's target range of 1 to 3%. And this is a very important conversation because the Bank of Canada wants to see inflation hit 2%. They've anticipated that that should happen by 2025. The question is, once we get to 2%, or how close do we need to be to 2% in order to see the Bank of Canada maybe pivot, hold, pause, obviously is yet to be determined. And we are going to look at some of those options and see exactly what the Bank of Canada may see. Will the Bank of Canada pause in September? Is that 0.25% increase already baked into the cake? We'll find out. Now, one thing is important to understand, this has been a very big conversation, is that even though inflation has been pervasive over the past few years, causing many difficulties in the lower half of society, if we were to strip out the mortgage interest cost from the headline inflation number, we would be at 2% currently headline inflation target, right? We would be at that 2% mark. And there has been a lot of controversy about that conversation, about how the data from Stats Canada can be manipulated. Obviously, core inflation numbers, food, energy, obviously still elevated. Now, looking at some of the housing challenges, obviously, it's difficult to see how true inflation actually is working out. But if you're looking to find a little bit more, there is a website called trueinflation.com, which suggests that inflation had peaked at around 11% in the US and is currently running at 2.3% amidst the economic backdrop. Obviously, just to take a little step on that true inflation number, many will argue that Canada and the US are very similar, but we do differ in our actual way that we produce products. So GDP per capita, for example, our GDP numbers, our industries are a lot different here in Canada than they are in the US. The overall theme is that inflation is trending downwards, whether that be through base effects or actually things that are starting to get less expensive. And I don't want to say that things are getting maybe less expensive, but they're not increasing. These prices for certain things are not increasing at the same pace that we saw just a few short months ago, or even last year, for example. So there might be some slight uptick in these items, particularly food and other fresh products like meats and poultry, so on and so forth. But the rate or the pace at which they're increasing is actually going down. And keeping in mind that these are lagging indicators, meaning that it could take months for us to see that increase like we did back just a few years ago when we saw inflation on food sort of increase, but it could take months for that to actually come back down as the R lagging indicator. So it's important to keep these things in mind as well. Maybe that will influence the Bank of Canada's decision moving forward. Now, Canadian home builders and housing starts in Canada are very important. They still continue to face challenges due to worker shortages, higher borrowing costs, and building restrictions, making it difficult to double housing construction. However, there was a significant increase of 41% in new Canadian housing starts in June, the largest monthly jump in decades. Obviously, it's good to see new starts increase. I think it's around 280,000 new housing starts across the board. I think we were down around 240,000. So it is obviously a big increase, but they do have a monumental task ahead of them to build the amount of homes that we definitely need, especially when we're looking at the rental housing market. But we do know anecdotally that things are a little bit more expensive, obviously providing some insight on current conditions on the rental housing market segment. Market conditions are indicating that it is tightening across many urban centers, especially the major metropolises, leading to increased rents. This is influenced by obviously the higher demand as a result of higher immigration and obviously the robust market for employment, as many of these jobs are located oftentimes in urban centers. Obviously, it has an impact on rental housing and obviously a major shortage as we bring more people into the country, which are desperately needed. The supply is struggling to meet the demand, even with increased construction efforts and rising interest rates. They have impacted home ownership for tenants. But investor disinterest in the rental sector may worsen as the rental housing crisis and the shortage continues to loom, especially with higher interest rates. So we're not seeing a lot of investors driving the market right now, and some may argue that's a good and bad thing, but obviously investors do create housing, they do create rental products so that people can actually afford to rent.
It can be problematic for the market in the sense that if condo investors find it increasingly more difficult in that buy and hold model, they may not be there to the same extent as in the past. And this is problematic for a market that relies heavily on condo investors. Condo investors have been great for the market. Without them, we wouldn't have nearly the amount of rental supply that we do today. So the fact that they're in a more precarious situation calls into question, how much more rental supply are we going to get out of them, and really calls for the need to build more traditional purpose-built rental housing supply, which we haven't really seen much of. When we look to the future, you have immigration levels rising, you have home ownership affordability at generational lows. Rental demand is only going to be increasing, whereas the supply, as we're learning, is actually starting to move in the opposite direction. Well, just the volumes are too low. The number of units that are starting construction on an annual basis is nowhere near the level that we need to satisfy rental demand.
If we continue on this thought process, the survey, from CMHC highlights some concerns regarding the share of units that are affordable or deemed affordable for the lowest income group, the 20%, which is limited in major centers, affecting vulnerable segments and future households. Average rents for newly rented units differ significantly from units occupied, let's say year over year, particularly in major centers with low vacancy rates. They are subject to obviously rent increase guidelines. So what this means, and when you're looking at this data, obviously if you're someone who's renting right now, you may be in a lease or a year over year lease, and you may have started several years ago. But obviously the cost to enter that rental agreement, and even with potential increases, is a lot lower than what the market rent could be for someone who's going in to rent a house today. And obviously with higher mortgage interest rates, obviously the cost of affordability, mortgage interest cost, all these things take into consideration. Many individuals who would have been home purchasers are maybe leaning more on the rental market. So that is obviously adding more people into the rental market, in addition to the higher immigration levels and obviously the numbers of employees and workers that need to relocate maybe to cities where their jobs may take them, right? So these are things to consider, but optimism in the real estate sector is obviously a little bit elevated. Despite these challenges, there is some optimism for the real estate sector, with the Bank of Canada increasing its policy rate 0.25%, even to the highest level it's been in 22 years. This policy rate of 5% still has some developers looking forward into the future and being very optimistic. For example, in a recent video or recent BNN interview with Barry Fenn from Lantera Developments, who's very optimistic about the future, believing it will perform well once interest rates stop increasing. And this is something that's very important to point out. Interest rates obviously are correlated to housing. Right now, builders are maybe not willing to build as quickly as they potentially wanted to when interest rates are elevated. But as we saw over the past little while, as soon as the Bank of Canada pointed to a potential pause, that could lead many Canadians back into the market, opening the floodgates. That is also a reason why the Bank of Canada may want to hold rates higher for longer, is they don't want that actual spending to happen in the market. Now, importantly enough, when we talk about the Lantera development, historically, large population increases in Canada contribute to these optimisms. And economist Robert Kavak, I believe that's right, who's from BMO Capital Markets, who supports the outlook, highlighting the strong supply and demand relationship in the housing market. Interest rates have kept at accommodating levels, lead to market rebalancing based on fundamental factors. So if you want to take that into consideration, we saw over the last 6 months that interest rates were still somewhat elevated, higher than they were in the past. Many Canadians, as soon as the Bank of Canada, as I said, hit that pause button, digested those rates, maybe changed what they were looking for rather than a detached. Maybe they decided to go with a semi or a town or maybe even a condo. But obviously there are still strong demands for housing in the Canadian marketplace right now. Canadians do believe in housing, although that is changing as many Canadians start to believe that homeownership may be out of reach. And that is an entirely different conversation. Now, role of mortgages on inflation or in inflation. Obviously, this is major. The Bank of Canada's interest rate hike was in response to these higher inflation numbers. So they're using inflation to fight inflation, raising the question about mortgages, the role in battling consumer prices. Mortgage costs rose significantly, obviously impacting that CPI number of 2.8%. It went up to 30%. Now, 30% of mortgage interest costs is huge when you look at the cost to Canadians to cover their monthly expenses, removing the ability for them to have extra disposable income at the end of the month. If your mortgage payment goes up $1,500 or $1,700 from what you'd originally signed up for, well, if you're able to get to that point, what's going to give next? Obviously, you're going to make your mortgage payments, you're going to try to pay your utility bills, and left over will be things for food and leisure. Interestingly enough, Benjamin Tal, who is the chief economist for CIBC, suggests that including falling principal payments in the Consumer Price Index or the CPI would provide a more accurate representation of inflation. It is also important to point out that Benjamin Tal believes that the higher mortgage interest costs that are obviously driving up the headline inflation numbers also are deflationary in the sense that monetary policy and inflation works as such. If you have less money left over at the end of the month to spend on other items or to spend in the economy, while it is actually putting more pressure and it's actually bringing, or it's deflationary because you're not able to spend in the economy. Remember, the Bank of Canada wants us to stop spending. Now, let's take a look at immigration, obviously a hot topic. Desjardins report stresses the need for Canada to increase immigration to counterbalance its aging demographic. There should be no argument here. As more Canadians retire, we need new Canadians to replace them in the workforce. Higher immigration is considered essential to support the economy and tax base as more people begin to retire. Who's going to pay the taxes to keep the economy and the country running? Challenges and solutions, however, there are many. The market needs to address the lack of supply and consider short and long-term prospects for all market participants. And encouraging private sector investment presents a major challenge, but crucial task for policymakers. So we need to start building those affordable housing, those purpose-built rental units for Canadians, that missing middle. And obviously, if it's not going to come from the government, it's got to come from investors and other major players that can introduce this inventory into the market. Obviously, now looking at what this means for higher interest rates. Major question, as Canadians understand, higher interest rates could lead to mortgage default despite new guidelines from the Financial Consumer Agency of Canada, the FCAC. Those guidelines aimed at protecting mortgage owners. The guidelines offer tailored support to at-risk borrowers and mitigate the impact of higher interest rates. In looking at those particular items, right? Looking at these items together, as the ink begins to dry, if we start to extend these amortizations, Canadians are going to face several different challenges, whether it be qualification to buy a new home, qualification to even refinance. As interest rates are higher, they have to qualify at the new stress test rules. Those Canadians who have extended amortizations that are 50, 60, 70, 80, or 90 years, obviously if they want to leave their lender, not only would they lose where they are right now with their current mortgage payment, even if they're not covering the interest that's being added back, many Canadians are still able to afford to live in their homes. And if they were looking at switching over to maybe a different lender, what does that mean? Refinancing, snapping that mortgage back to a 30-year amortization means their payments would have to potentially go up. And I believe that the banks are going to be holding a lot of Canadians, hostage when it comes to their options down the road, even though they are introducing some measures to help relieve some of these pressures, like no prepayment penalties that they have to sell, obviously not charging interest on interest. And we'll, as I said, we'll do another video on this as soon as the ink actually dries and we have some concrete data on what these things actually mean to Canadians. In summary, the Canadian housing market faces a lot of challenges, including inflation, stagnant activity, and rental housing shortages. However, for many, there is still optimism for the future, and policymakers must address supply constraints and consider immigration roles to ensure a balanced and sustainable housing market here in Canada. And just as a side note before we end the video, this video has been circulating with Jagmeet Singh, the leader of the NDP, talking about making sure that Canadians can stay in their homes and maybe offering them some subsidies or particular incentives that could benefit them greatly. And I'll clip to the video here.
Well, we know that people are feeling this across the country, and people are feeling this here in Windsor. I've spoken to people, they're saying, what do we do? The mortgage rates or the interest rates have gone up so quickly and so rapidly in such a short period of time. We are struggling right now. And I gave that example. If you were a family in the past couple of years that has a 25-year variable mortgage, you're looking at your mortgage payments and seeing an increase of over $1,700. How is a family supposed to come up with an additional $1,700 when grocery prices are up, when gas prices are up, when everything is more expensive? What are families to do? And the relief offered by the Liberals is just not good enough. And it's not surprisingly because they're not in connect. They're out of touch with what people are really going through. And the Conservatives are not proposing any solutions immediately right now to give people relief. They don't care. They're not actually talking about that. We're talking about what we can do right now to give people relief. There's a lot of countries that are looking at real solutions to give people a bit of break who are struggling with the cost of the mortgage. We want to see those aggressive steps being taken here in Canada. Steps like Spain has taken to force banks to give lower interest rates to families that are struggling. Like Portugal has put in a subsidy for people that can't pay their mortgage right now. We need to see some aggressive measures put in place to give people some relief, to give people a break so they don't lose their homes.
And now that you've seen sort of what he had to say, obviously, whether you agree or disagree with his policies or his political stripes, we're not trying to get political with it. What do you think as a Canadian about introducing measures to help Canadians who find that in a distressful situation, who might be facing the possibility of losing their home? I want to hear from you in the comments sections below. Let us know what you think. Thanks for watching. And remember, if you're not subscribed to the channel, please subscribe. Don't forget to hit that notification bell. Leave a comment in the comment section below and make sure you like and share the video. But we'll see you next week. Thanks for tuning in.